not a sky. So I do love the new.
You're like the earnings.
The new purple glasses are amazing. You look great.
Thank you.
I'm not. Listen, I'm here with you on set, and the S&P's down 40 bips. That feels like a relative outperform for us being together this year.
I'm serious though. I mean, is it really that bad? Is there another story to tell other than negative, negative, negative?
Look, there always is, and we've talked about this for the last several years. You always sound dumber when you're bullish, right? Because when you're bearish, you can really sound intelligent. I just think the problem right now is if you think about corporate earnings, they're way too high. Everyone knows that, but they're too high. So can the market act well when they come down? Yes, maybe. Mm-hmm. As long as people think when they're coming down, they're going to plateau and moderate, right? So when things are falling, will you believe, all right, that's good news because now things are achievable in Q4 or Q1? It's a debate. We'll see what happens in September and October. Right. And then the other issue is the so-called PE ratio, the multiple. And that's the part that I think is hard to get bullish on when you know quantitative tightening's there, you know the Fed's acting hawkish around post Jackson Hole. So I think that's why the cocktail's gotten a little bit more negative in the last couple of weeks.
So I will be the first to admit, because I find myself in this position on a twice daily basis.
You're a little negative, yeah.
No, I'm not saying I'm negative. I think it's hard to push back against the negative because there's a lot to be negative potentially about.
Yeah.
Playing devil's advocate against the negative is not the easiest thing in the world because it's hard to find the catalyst to bring the buyers out.
Yeah.
What are they?
Look, I think it would have to be something like, all right, corporate earnings are probably going to be about 209 this year. The street's at 243 next year. The real number's 215. Maybe if it's 215 or 220, and that's really where it comes down, and we believe earnings are higher in 2023 than 2022, the market will rally. It will rally on that. It's going to be, that's possible. I think it's too early. We talked about this a few weeks ago. Analysts come back today, the day after Labor Day. They've been in the Hamptons and wherever.
Now they get
and they start sharpening the pencils. They're like, I got a real September in front of me, and I better figure out if my 2023 numbers are a joke or not. And you know what? They're probably too high. So as companies go out, they do big conferences, in the next couple of weeks, I think you'll see numbers start to come lower, and we'll see if that sets up for a better risk reward to October earnings. But right now, I think the risk is skewed to the negative just because the expectations embedded in the numbers are just egregiously optimistic.
So that's a fair assessment. The question is, they're skewed to the negative. How negative? The risk is skewed. I mean, we're at 3,900, just north of that on the S&P.
Yeah.
What does that mean? Are we going back to the June 16 lows? Are we going below that?
We're at 18.5 times the current numbers for 2023. And, we're at 16.5 times the current numbers, 18.5 what I think the numbers are. The long-term average is 17. I'd feel probably better if we were 10% lower about the risk-reward. So it's just hard to say this is the time to get in. Now, underneath the surface, there are a lot of stocks that trade way below 15 times earnings. And so I think the whole game right now is relative estimate achievability. Where are the numbers more relatively achievable than others such that I can deploy capital and beat the market? So that's mostly what we're focused on.
You're not universally negative then. There are pockets within the market that you've identified that you think investors can put fresh money in.
I do. We talked about it a little bit last week.
Energy?
But I think healthcare. I really like healthcare. I know the last person in the last hour just talked about it. But when I think about portfolio strategy, you talk to me, what do you think is going to work, and I'll find you something in healthcare I like. If you want to play defense, I'll take pharma over staples. Same dividend, more achievable estimates.
Okay.
You want growth, you want offense? I think biotech looks better than software. It's just discounting very little in the terms of safety and efficacy. You want services, you think it's a service economy? I like healthcare services over consumer services. So I can find a way across the portfolio to generate pretty good risk rewards.